An analysis on Asian Paints, no matter how expensive the stock remains, it also remains popular amongst investors. Does the growth justify the valuations, though, is the question. Yash Upadhyaya is standing by to put things into perspective. Yash, why have we chosen to speak about Asian Paints today?
So one of the biggest points that most people have against Asian Paints is how the return ratios have been deteriorating, and on the other hand we've seen the valuations continue to be higher. In fact, at one point in time last year, Asian Paints was the most expensive stock on the Sensex as well. It continues to remain one of the top 5 most expensive stocks on the Nifty as well. So let's take a look at the return ratio trend over the last 10-year period, and what we've observed is the fact that the return ratios have slowly and steadily deteriorated from the highs of almost 57% return on equity in the year of 2010 to now somewhere around 24% in the lower 20% in 2019, when we've seen that consistently drop over a period of time. On the other hand, what we've seen is that the stock continues to remain extremely expensive as far as the valuations are concerned. So let's look at how the PE multiple of the stock looks like, and this is the Bloomberg estimated PE for the counter on a 12-year blended forward basis. It is currently quoting at around 59 times, which is still at a premium of almost 6 to 7% over its average in this period. So the average line that stands at somewhere around 55 or 56, and the Bloomberg estimated PE stands at almost 59 times. So that again is just an indication of how expensive the stock is, even on a forward earning basis. Take a look at how the analyst recommendations are, and despite a whole host of analysts covering the stock, almost 38 analysts, the views are completely split. Over the last few years, we've seen the number of analysts going from buy to hold increase substantially, and now it is almost split. So 18 out of the 38 analysts, they have a buy recommendation, while 16 have a hold. The stock did come off before its Q3 earnings, as a result of which we've seen the return potential go up slightly, coming up to about 6.8%. But because of these extremely high valuations, they see a very limited upside in the stock. But what is it then that the investors continue to like Asian Paints so much, and what is it that they see comfort in? Well, one of the biggest reason is the fact that they have consistently managed to deliver as far as the volume growth number is concerned. Despite concerns with respect to GST, demon, RERA, as well as the overall consumption slowdown impacting the consumption in the country, they have consistently delivered on the volume front. In fact, when their Q3 numbers came out, that was the 8th consecutive quarter that the company reported double-digit volume growth, and that is something that a lot of analysts as well as fund managers that I spoke to see a lot of comfort in, because that is where they see a visibility in terms of growth coming in. And as you could see, for 8th consecutive quarter, they've reported double-digit volume growth, and that is something that is absolutely commendable for the company. Now, in terms of the management commentary, it was not just in the third quarter that they said this, but in the second quarter itself, they said that their focus is not going to be on margins. Their focus is going to be on volumes, and what is going to drive this volume is their strategy towards the bottom end of the pyramid. Now, what exactly is the bottom end of the pyramid, and what are these products? They are basically their low ticket products, which is your distemper, putty, as well as the economy emulsion paints, which they are particularly targeting in the rural as well as the tier 3 and tier 4 cities, and they see a huge growth over there, because compared to the premium products, unorganized sector has a hold of almost 30% in this economy version, and that is where they are seeing huge growth coming in for the company. As far as the revenue mix is concerned, in their Q3 con call, they've said that almost 50% comes from the rural area, and the remaining 50% from the urban area. But the rural as well as the tier 3 and tier 4 cities, they are consistently having been growing faster than the urban as well as the metro cities, and that is where most of the analysts see huge potential for the company going forward as well. Now, one of the critics of their strategy of focusing more on volumes as compared to margins has been that over the long term, with crude oil prices moving, it would be negative for their EBITDA margins. But take a look at the margin trajectory for Asian Paints compared to the other peers, and despite of whatever has been said, they command the highest margins in the industry. So almost 18.5% for Asian Paints compared to something like a 15% for Berger Paints, 14 for Kansai Nanolake. Obviously, it has a higher share of the industrial paints business, which puts pressure on their business. But even AkzoNobel is down somewhere around 11 to 12%. So even with this, they continue to garner the highest margins in the industry, and that should not be a significant cause of concern, as what some of the market participants are also telling us.